All right, thank you everyone for being here today. Since it's February, tax season's already underway and it's on everyone's mind. So I'm here today to talk about what are some important tax changes that small business owners need to consider and what you should be paying attention to now. So we have the one big beautiful bill, and you've probably heard a lot about the big beautiful bill lately. So I wanted to touch on it briefly because there's a lot of noise. The majority of this bill is designed to benefit W-2 earners, things like no tax on overtime, no tax on tips, and expanded benefits for seniors. I've actually done a series of quick 1 to 2 minute YouTube shorts breaking down those pieces, the no tax on overtime, no tax on tips, senior benefits, and more, because they're really important for employees to understand. But for small business owners specifically, there are not a lot of new headline deductions in this bill. The bigger impact for business owners is still indirect. The bill also increased the IRS funding for data and enforcement, which means more technology, more comparison, and more follow-up questions. And that's exactly why the rest of what we're going to be talking about today matters. So while the W-2 earners may benefit from the headlines, business owners still win the same way they always have, through planning, structure, clean books, and documentation. And if you would like to check out my YouTube videos, I'll have a slide at the end that shows you how to find us. Okay, one of the biggest misconceptions I see every year is that taxes are a once a year event. They're not. February is when the problems are starting to be discovered, but January through December is when they're actually created. The decisions that you're making right now will shape what your 2026 tax return will look like. If we're trying to fix 2025, we can't do much with 2025. It's done. Like, it needed to be done by December 31st to make any impact on last year's tax returns. So what we're talking about is really going to help you for 2026. So one of the biggest shifts business owners need to understand is that the IRS has decades of tax return data on us. And they're now using AI to analyze it. They knew about AI and were using AI before we knew about it, quite frankly. And this is where they're putting their money in. I started finding out about this in November of last year and started digging into it, and that's what we're going to talk about today. So with the IRS having dozens, like decades of our information, they know what is normal for your industry. They know what's normal for your revenue levels for your industry, and they're going to be comparing your return automatically. This isn't personal, this is pattern based. So I wanted to give you an example of how this is going to work. Let's pretend that you have an HVAC business. Based on the IRS data, and your income level that you're generating in your business, say a travel expense might normally be around 12% of gross revenue. If your return shows a 25% in travel expense, it doesn't necessarily mean that it's wrong, but it does mean it stands out. And when something is outside the normal range, AI is going to flag it, and then that's when the letters are going to start coming out. I really expect this to start happening this year for everyone. And then what you're going to do is you're going to take that IRS letter to your tax preparer. So I want you to know that there's a really important distinction. Your tax preparer prepares your return based off of the information that you provide to them, usually your bookkeeping and your profit and loss. But it's the responsibility for providing those expenses is always up to the business owner. When the IRS letter comes, the question isn't, did my preparer mess up? It's, can you support what was claimed? The burden of proof is always on the taxpayer. So what's going to happen is you're going to take this tax letter to your tax preparer, whether it's a CPA, EA, or a tax preparer, and they're going to start digging into your bookkeeping. They don't have to verify anything. They're assuming that what you give them is correct. So they're going to start digging into your bookkeeping and they're going to start asking you questions on travel because that's what the IRS is asking about in this particular case. If the bookkeeper finds out that the big extra, say 13% of travel in that HVAC company was actually due to a personal vacation that they took their entire family on that had no business done on it whatsoever, wasn't pre-planned, wasn't documented correctly, the tax preparer is legally obligated to give you your options. So they can't sign off on it and lie to the IRS. Like that's against our code of ethics. So what will happen is one, they will let you know that it isn't correct and that an amendment needs to be done, taking out the family vacation. Now you'll have less expenses and you will owe more in taxes plus interest and penalties. The other option is you refuse to amend it. The taxpayer won't sign their name to it. And now the IRS will come in and start wanting proof and documentation for other categories. Like basically, you've opened up a can of worms, and now you're at risk of getting everything audited and going back for several years, not just that year. Because if the IRS finds something, they get to go back and keep on looking, especially if they find a pattern. If you don't have adequate proof or documentation to support your expenses, the IRS will disqualify those expenses, and now you owe a lot more in taxes, penalties, and interest. So, this is why it's really, really important to have bookkeeping. Good bookkeeping just isn't about knowing your numbers, it's also about defense. Clean, consistent books reduces the questions, it provides you with real time documentation, and it protects you. Trying to recreate your records later turns into damage control instead of protection. So, what the IRS expects to see, like these are things that they actively look at. They're going to want to see your mileage logs. Is it already done? Like, I personally use MileIQ and I recommend MileIQ to all of my clients. Um, they'll want to see, the business trips and everything. The meals, they want to see any receipt over $75, they're going to be asking for. So meals, who and why you were meeting with them. Home office, is it exclusive use? Um, like you're not doing anything else in that office space. And then family payroll, like family payroll, they'll want to see job descriptions and timesheets, W-9s or W-4s on the kids or any family members that you're paying. So now that I've talked about the AI and what I realized in November is coming for this year with the IRS and how the IRS is trying to come up with their shortages and not, really hire more people. I want to talk about an underused strategy that people, small business owners, it's available to people, they're not using it. So a lot of business owners miss out on family and legacy strategies because they sound complicated, but they can be very powerful when done correctly. Paying family members for real work, teaching your kids, having them earned income, and even funding their Roth IRAs for working children are all legitimate strategies. However, they must be documented properly. AI doesn't care who you paid, it cares why and how. And some of the mistakes I see every single year, these are patterns I see every year. Waiting until you file your taxes to ask questions regarding last year, mixing personal and business finances. Business really needs to keep their business business and their personal personal. It creates a bookkeeping nightmare, for one. It can also be the downfall of your business. And if, say, you get sued and you're in court and the judge has seen that you've pierced the corporate veil, like they now have access to your personal stuff, which was why you created the LLC anyways, is to protect you personally, right? And also another mistake I see is people assuming their software or their CPA will automatically equal strategy. Again, the taxpayer, whether it's a CPA, EA, or a tax preparer, they prepare your taxes based on the information you give them. Tax strategy isn't included in tax prep. That costs extra and it should be done throughout the year. It's not an after the fact thing. Also, chasing quick tax tips on social media without understanding how they apply to your business is another mistake. Tax tips are great, but there are rules and documentation that is required for it to stand up in a review or an audit with the IRS. And if you don't know what those rules and documentation are for the tax strategy, don't implement it. Get advice from a tax advisor. Most tax problems aren't bad luck. They're predictable patterns. All right. So, very lastly, the takeaway for 2026 is simple. Focus on clean, consistent bookkeeping. Document things as they happen and make sure your numbers make sense for your industry. And remember, the goal isn't to avoid taxes, the goal is to stop overpaying them and to stay in control. Now, right, there is my information if you need it. The YouTube, I do a weekly YouTube every single week, and that's how you can find me and be able to do the YouTube.